Big banks are cutting bonuses for investment bankers and traders, which indicates some of their worries about their economy and what's coming next. And today we got some new jobs data which said that we hired more people than expected, which might sound like good news, but it's bad news for Wall Street because that also means that it's more fuel for the Federal Reserve Bank to continue raising interest rates aggressively. So let's jump right in. This is December 2nd, 2022, and let me start by talking about big banks. Because big banks, while many of them have been seeing growing revenues, there are certain divisions in their companies which are starting to hurt, particularly the investment banking divisions. Across the 5 biggest banks in America, they have seen their investment banking divisions lose revenue by 47%. The revenues have fallen 47% in just the first 9 months of 2022. Why? Because the valuations of everything, including their investments, are falling, so they don't have the same ability to keep paying out the same bonuses that they did before. Now, if we kind of backtrack 9 months ago, these are the same banks that were offering huge rewards, huge bonuses, and huge perks to bring these bankers onto their firms. Now, they're cutting bonuses and they're cutting potential incomes. Now, this is not to make you feel bad for the investment bankers or the traders. What I'm saying this for is to get you to understand what this could potentially mean for the economy, especially in the eyes of banks, because banks don't like cutting people's salaries. They want to keep paying you more because the more the bank makes, the more they want you to make. That way you keep working harder for the bank to drive more revenue for the bank. So if they're cutting bonuses, they're worried about what could be coming with their profits and revenues, especially with certain divisions. Now, while many banks have been seeing revenues growing, banks are getting more worried because what typically, when you see these types of bonuses being cut, typically that's an indication for layoffs coming at some point in the future. That's what we've seen happen in the past. And Morgan Stanley, the CEO of Morgan Stanley, came out recently, and what he said was, quote, "Some people are going to be let go. We're making some modest cuts all around the globe, and most business, that's what you do after many years of growth." So you have banks now that are starting to see the pinch of the economic slowdown, that are starting to feel the pinch of the higher inflation, and that are starting to feel the pinch of rising interest rates, because rising interest rates affects the valuations of things. For example, when you raise interest rates aggressively, now it's more expensive to buy a home, and people don't want to pay the same price for a home, which causes home prices to fall. That's one of the ways that it affects valuations. And it's not just homes, it affects the valuations of all different types of assets because it makes borrowing money more expensive, which hurts the valuations of the investments that some of these banks are making. So something that you want to be paying attention to. This brings me to now the jobs report. Now, before I jump into this, if you haven't joined Market Briefs yet, we cover all of this in Market Briefs, which is my free financial newsletter. It's a super simple way for you to stay up to date on what's happening in the financial markets, from things like the economy, to the stock market, to real estate, to crypto, to the global economy. Not only is it fun to read, not only is it brief to read, but it's also completely free. I promise you, you're going to love reading Market Briefs every morning. And if you're saying, but just what if I don't love it? Well, then you can unsubscribe. It's not going to cost you a penny. So if you haven't joined Market Briefs yet, I'll put the link to how you can join down in the description below. Now let me jump into this topic of the jobs report, because the jobs report said that we added 263,000 jobs as opposed to the 200,000 jobs which was expected. Now this, in a normal economy, would be great news. In a normal economy, would cause the stock market to rally. In a normal economy, everybody would be cheering the good jobs data. But you have a lot of people in Wall Street that are now looking at the jobs data and all types of data, from inflation to everything else, and they're not analyzing it at face value. They're analyzing based off of what this means for the Federal Reserve Bank. Because right now, we have the Federal Reserve Bank that's going to meet in a couple weeks, and they're going to discuss what they want to do with interest rates. On December 14th, they're going to announce this. Now, Jerome Powell has kind of been hinting that they want to moderate how aggressively they want to raise interest rates, but we don't know when, and we don't know how much moderation they want to do. Now, we all know that raising interest rates affects things. It affects the prices of things. It affects the valuations of things. It affects the health of the economy, because as soon as you raise interest rates, it makes borrowing money more expensive. But it also affects inflation, because we're still facing some of the highest inflation we have seen in decades. While it has come down, it is still extremely high. So now when you have a good jobs data, what does this mean? Well, the Federal Reserve Bank has been saying very openly that the job market is too tight and they want to cool the job market. Now, if you dissect what that means too many people have jobs and we need more layoffs. We need people to lose their jobs. This is what the Federal Reserve Bank is saying, and one of the decision makers, one of the decision factors that they look at when it comes to how aggressively they raise interest rates is how tight the labor market is. How tight the labor market is means how many people have jobs. And so if lots of people have jobs, it's more fuel for the Federal Reserve Bank to continue raising interest rates, because if you raise interest rates, it makes doing business more expensive. If it makes business more expensive, that means more layoffs, because then businesses have to cut their costs. So while it might seem weird, why would the Fed want to do that? That's one of the things that they say is important in order to bring inflation down. This is what the Federal Reserve Bank is saying. And we have a couple economists that commented on the jobs data that came out today. And let me just read you a quote. It said, "For those who believe the Fed will be cutting rates next year, we would remind them that inflation wasn't transitory, and that this jobs report is another example of why the Fed is going to be fighting inflation for a much longer period than many currently expect." So we have on December 14th, the Fed that is going to announce what they want to do with interest rate hikes. And even if they start moderating, it doesn't seem like inflation is going to be going down to their 2% goal anytime soon. So you can expect interest rates to continue to rise so long as the Fed sticks to what they say, which is raising interest rates until inflation comes down to 2%. So what does this mean for the economy? Well, you have a lot of different opinions about the economy. I have my own opinion, you have your own opinion, everybody has an opinion, and this is where you really just want to be prepared for anything, because it doesn't hurt to be prepared, but it hurts if you're not prepared and something bad happens. So it is extremely important for you to be prepared. Just yesterday, I believe, President Biden came out and gave a talk about the economy when some of the inflation data came out, and what he was saying is inflation is falling, we have won the fight on inflation, and people's wages are rising faster than inflation. Now, I don't know how true that is. Actually, that is not true at all, because inflation is still almost 8%, 7.5%, more than 7.5%, and average wages are not rising by 7.5%. However, when you have people talking about how we have kind of just bypassed the recession, we've bypassed any economic pain, the reality is we haven't really felt the effect of higher interest rates. Now, the point of this isn't to be political. The point of this is for you to take care of yourself financially, because everybody has a bias. I have my own bias. I want you to join Market Briefs. Everybody has their own pitch. Everyone has their own reasoning. Listen, at the end of the day, if you're not prepared, then you pay the price if things go wrong. If nothing goes wrong, then yeah, you're fine. But if things go wrong and you're not prepared, now you're the one that's paying the price. So what does this mean? Just be prepared for everything. Put some cash aside to protect you against a financial emergency, and have cash aside to be able to take advantage of distressed assets. If the economy does hurt in 2023 and 2024, because I personally, again, I could be wrong, but I don't think this economic pain is going to be gone next year. I don't think this inflation problem is going to be gone next year. I think we got some pain ahead. If there is more pain in the coming years, you want to be able to capitalize on the opportunity, and you want to make sure you can take care of yourself. So prepare by putting the cash aside and be educated. That way you can take advantage of opportunities. Now, of course, we cover all of this in Market Briefs, which is why if you haven't subscribed yet, make sure you do so. But start educating yourself, invest in your own education, spend some time watching YouTube videos, read books, and do whatever you got to do to start learning about what it is that you like to invest in. Because if you've never invested before, well, you want to start. It's always, today is always the best day to start. But always keep learning. That way you can find better opportunities around you. Thank you for watching, and as always, keep hustling.